Hey guys, super happy to be here today. And you know that I really like to bring up some new surprises and some new perspective to you guys because I think it's a tremendous experience to hear more about like the industry and how other component and other parts of the industry actually come together and relate to each other. And today I have the perfect guests to explore and to unveil um, all the topics they like we're not speaking on a regular basis. And it's a fantastic opportunity to do so. So Toby, it's a pleasure to have you here. I'm very glad to for the opportunity to have that recording session with you. And yeah, I'm very excited. How are you today?
Yeah, good. Like I said, apologies if you hear any noise in the background. I've got someone that's decided to cut down a tree on the same day, but I'm sure it won't impede us too much.
I really like the timing. I think that cutting up a tree like in 12 p.m. I think it's like instead of lunchtime, I think like it's the perfect dessert. But okay. Let's never judge other people by their decisions. And yeah, how are you?
Yeah, I'm good. I'm good. How's
Good,
things? I bet your
good,
weather's
good,
better than mine.
good. Um, I bet your weather is better than you. Like my weather is better than yours.
Most
Obviously, I'm
probably.
located in
Yeah.
Tel Aviv. You're located outside of London. Here it's sunny day. You can see people going to the beach and everything's like perfect. Um, but yeah, before we're going to be getting started in like diving to the details that we have planned together previously, I would love if you can present yourself to the audience, let them know who you are, and let's dive into your expertise right after.
Yeah, sure. So my name's Toby Morris. I have spent the last 17 years in the market. Mainly started off um, in CFDs and spread betting, so leverage derivatives, and that's really what I was doing for the sort of first half of my career. I started off. I've been at the two sort of main players. I don't think I really need to name them, but we first started off when I first started off. I started off in 2008 actually, so it might be just coming up to 18 years. Um, and it was a very different world back then, obviously. So a lot of stuff was still phone traded back then. Very different world. But I earned my stripes pretty quickly in a very fast learning environment that a lot of people that are from that era or before will be very familiar with. And then we transitioned over. I moved sort of sideways within the industry, and we started up a desk from scratch, a sales trading desk from scratch, to really try and plug that gap of where everything was transitioning online, and there's still that gap there, either by preference from clients or by need because they want to do something that's not really compatible with a platform or is too big or needs some care or whatever it might be. So we had a high touch desk that we set up. Um, it it was really good. We saw a huge amount of growth through that. I think we made a bit of a name for ourselves within the industry for being sort of the go-to place for that sort of very high level execution service and
Mhm.
relationship management as well. And then my
Very
role
good.
sort of transitioned from there a little bit. We saw
By the
ourselves
way,
being
what era are we speaking about?
so that probably takes us up to where are we now? That probably takes us up to about 2018. And then what happened?
2018.
Yeah, what happened from there was two of the more senior people that I'd moved over with, they went off to do their own thing, um, and that left a lot more of the integration with the rest of the business, I would say, fall on us. So we started getting into more the weeds of both execution, operations, settlement, all that sort of stuff. Um, so what was a still in theory a sales trading role, my role title towards the end was head of sales trading and execution, and it was a lot broader than a lot of people would probably expect with that job title. So that's where we start to have maybe more crossover with some of the people and topics that you get on this show, with
Mhm.
you know
Correct.
looking into the specifics of execution, whether that be systematic or STP execution, where you've got no part to play in it, and you're just making sure that the plumbing um, is reflective of what is expected from that particular asset class or platform or whatever it might be. And then you've still got this high touch execution where people are starting to transition away from some of the more old school phone broking type stuff where you go to a market maker and trying to take a little bit more control themselves. And that sort of really takes us to the current day in terms of a very very high level my how I've gone through various different roles over the last 18 odd years.
Mhm. No, it sounds spectacular. Like everything that you have done over your career, especially since 2019. But I would like to tackle some questions with you. First of all, relationship manager. I think that people tend to avoid like the relationship and the importance of the relationship itself in the financial world. And I would like to dive deep into it a little bit more. And I would love if you can literally explain. What a relationship really means. How do you actually handle a relationship? How do you actually tackle a relationship at first, and how do you grow the relationship together in order to make it much more sustainable and efficient for both of the sides, business wise.
Yeah, it's a very interesting question. So again, it depends. That really changed over time because when I first started, striking relationships with clients was relatively easy because 50% of orders were still phone broke. So you're speaking to people every day, and it's very easy to get a rapport and get used to what they like, what they don't like. Try and set up a meeting. The best relationships are always forged over a drink. Um, Such is the way of the world. And it was just very easy to run into to setting that up and setting those relationships up. So you didn't necessarily have to go out searching for something. There were people that weren't really interested in that side of things. It doesn't mean that you're not still giving very good service. You're giving the service that they want. They don't
Okay.
want to be wined and dined. They don't, they're not interested in that side of things. But it's very easy to learn more about someone's character, and to strike up that initial conversation if you're naturally talking to them over the phone multiple times a week anyway. So that was 2008. Look, loads of things were completely different back then. It's like chalk and cheese compared to how people get into the industry now and kind of earn their stripes. It's not recognizable. The old way of phone broking, not only just phone broking orders, but voice orders within a desk. Gone are the days where a trading desk would be particularly loud. People shouting at each other all the time and shouting each other down, and arguments striking over whether or not something's filled, not filled. It was a very different experience to learn in. But the clients themselves, it was a lot easier back then. And then you transition to when 2000 and I would probably say 2010, 11 was the first time that we started really seeing an acceleration of orders going online. Um, the speed at which things went online, and then the next was
Before,
mobile.
just a quick question. Before 2011, 2010, around those years, like you haven't really identified any type of acceleration going online, like in terms of orders or frequencies, or what was like the major differences like in between those 3 year bridge.
Sorry, are you saying when did that transition happen, or how did it happen, etc.?
How did it happen? How can you really identify and how can you transition your business and
Uh,
yourself
I mean, it
into
just
it?
happens. Clients adopt new technology a lot quicker than you would ever expect. So,
Really?
yes, always, because the expectation was, I mean, internet speed. So if you look at your average client, for example, in our world we have a mixture because it started out. I'm going to use the term retail, and that's a very mixed term. But you can think of retail as being anybody that isn't an institution. Now they could be doing institutional sized business, and some people trade for a living, and that's all they do.
Sure.
But the bulk of clients that will come through that we spoke to in the early days, it wasn't their main job. There was a small subset of people where it was, but for most people, it was a bit on the side. It was it was either a passion or a way to make a bit more money on the side, etc. And if you think about the environment that they're going to be trading in, most of the time it's at work. And well, either if they're at work or at home, they all have their own unique problems back then. Because if they're at work, you've got to worry about, am I being watched? Should I really be doing this? Are compliance going to be unhappy with it? Is it going to affect the quality of work that I do at my day-to-day job? And then if they're at home, back then you had issues with connectivity speeds, and
Hmm.
not necessarily the speed, but the consistency of a connection. So I
Hmm.
think a lot of people felt that there would only be a niche group of adopters of trading online, and that was completely wrong. People were very, very happy to try and move to trading online, even though there might be issues, etc. They adopted it very quickly, and their confidence with it was a surprise at the time. I think it took everyone by surprise. And then you have another step on top of that. I mean, the early online platforms were all, a lot of them were software based, and
Okay.
then all of a sudden you had the next kind of wave, if you like, was to put it all to get it all on being web based, because the draw of that was, if I'm in a workplace, I'm not going to be able to download a piece of software to be able to trade, but I can potentially use it through web. But again, it was the same cycle all over again. People thought, well, if it's not a downloadable piece of software, people aren't going to trust it in the same way. They're not going to use it. And they did. So you see this progression of trust in technology very quickly. And then it's a race to the next thing, the next big thing. So then it was mobile. I mean, mobile started as, it's probably, depending on your age, you might not remember it, but mobile started, internet connection on mobile, web-based stuff started as something like WAP, it was called, and it was absolutely awful. um, and the first people that managed to get I can't actually remember who it was, but there were two or three within the industry that really made an investment in trying to get a mobile platform as well, and there was one far before the rest. And it wasn't brilliant, it's no brilliant bells and whistles, but they saw huge volume go through that, because again, it was, people were willing to take that step and say, okay, well, my connection might not be perfect. I've only got 2G, 3G, sort of 3G connection back then. But if it doesn't work, I can always ring up.
Hmm.
And again, people adopted that, and it saw huge volume shifts. And I would say probably, I mean, by the time I started, when I transitioned over within the industry to my next role, that was 2012. And by then, the vast majority of orders were going through online or via mobile. And if you look at it now, I mean, it's 99.9% of orders probably, between a combination of phone and mobile and main web platform. And a lot of that is now shifted over to mobile as well. So people adopted it a lot quicker than you would ever expect.
So, uh, it's very fascinating that people actually adopt fast, but I don't see like nowadays I do see like especially here in Israel like a massive adaptation to a tremendous amount of new applications platforms that people like to jump over, and I really think of like how do they influence the market and how they get influenced by the market? Because I do think like I have the hypothesis nowadays that I developed. after being a manual and discretion trader, that being a discretionary trader is way harder than it was like 2 years ago, because the market gets very effective and very efficient every day, and people makes their the execution gets faster, and everything is literally accelerating itself, and especially with the newer bit of artificial intelligence, machine learning, as how machine learns and how they train the models, like deeper networks, deeper models. Like being discretion trader is going to be like that's completely my thought about like an individual thought that I'm actually developing nowadays. I think that discretionary traders will disappear at the moment, because it's going to be it's very hard to manage, even though you have the right experience and the right trajectory of of learning, uh, and um, and doing the right things. But what I'm trying to tell you is, like, in terms of adaptation, in terms of acceleration, and how everything got literally started from 2010 towards nowadays, and how it will be from nowadays. I do think that people should come up with something that will be much more resilient in terms of like systemize their ideas, or trying to understand how to participate in the market, not by doing everything manually, like 100%. And I would like to ask you, out of your experience being there, executing large orders and working with clients, and like working with institutions, like moving some tremendous amount of capital, like in the markets. I would like to ask you, what do you think about my hypothesis? How do you think that the market will evolve over time, like from like the day that we're reporting, which is 26th June, 2026, and how it will be going from here? And how do you actually suggest, and will give and give your advice to other companies like you have developed, and other pioneers that will appear over the years, and how do you like take your experience and enable them to leverage it?
Yeah, it's a very broad question. I mean, there's kind of where we are up to today, and then predicting the future is a whole nother game. But um, if you look back to from when I started to now, that sudden change, and there's different facets to this. You've got I mean, when I first started, for example, there were more clients that I would say could, I don't want to say game the market, but they are they could profit directly from inefficiencies in the market. And that is, again, that's about the acceleration of technology and getting on stuff early. So if I go back to one of the earliest clients that I ever used to look after, he very early on, people now use blue the amount of information that you have at your fingertips now is absolutely incredible. But if you go back to 2008 and beyond, in that real sweet spots from early 2000s up to sort of 2008 2010, if you adopted something early, sometimes that could give you an edge, which was really only available to institutions. So here, for example, very early on, there was the LSE used to give essentially some sort of device that they gave out to you, which was like almost like a pager, and you could see live pricing through this, and you'd get an update once every 10 or 15 seconds or something like that. And they were incredibly expensive. He paid an absolute fortune for something that nowadays would be laughable. Um, but that slight edge in timing, he made a lot of money out of, you know, single stock moves, or especially when things started moving into things like binaries and stuff like that, where it would be where's the next tick on a specific index going to be. There was an edge there that was available potentially. I mean, he was in the know, yes, but it wasn't. That was him acting as an individual rather than an institution. And there were little things like this that happened as exchanges were modernizing, and companies themselves, any companies that offer um, are acting in principle on trading or market making something. If they put out a bad price, there was the opportunity to make some money out of that. And that was quite early on, and there was the ability throughout that whole period where there were new players would come in and they'd try the same things time and time again that they've learned over the past, however often it was, whether that be treatment of dividends, speed of price. There's lots of different, sorry, price latency rather. There's lots of different ways to do that, whether you call it gaming or just being, just finding a quirk in the market that you can take advantage of. And that really disappeared because everything just became so fast that the speed at which you would have to react was just not available. The infrastructure is not available to a retail client. They
So
can't game.
how do you as an executional as an execution part of the market actually reflects to that new era where finding inefficiencies or building alphas or even betas as like not on top of inefficiency in the market actually looks like because you're when you send me the text message over WhatsApp, and I saw like few times like a handful of times the word execution. And when you're actually, how do you actually reflect like the execution aspect in the market nowadays, like executing large orders? How do you actually find the efficiencies? How do you actually
Yeah,
leverage the algorithm? That's a thing that will kill me incredibly curious because like inefficiencies are literally we have passed that era like 10 years ago, and nowadays like alphas are built upon numerical calculations. How do you as a manual executor actually find the most reliable execution point to execute your orders?
yeah. It's interesting because we have to be very cautious about what it is, the method by which we're executing something for a client. If you adopt too much discretion on an order, you have to ensure that the client fully understands what it is that you're doing, because that can cause either confusion or dispute or whatever it might be on the way that you've executed an order, just because they don't really understand it. So, give you an example. If someone wants to go and buy, I don't know, a quarter of a day's volume in a stock, and it's a mid-level, mid-cap stock. Now, you can just ring a market maker, for example, and just get an outright price for that. Or you could be very aggressive on an order book and go to the exchange and buy it right there and then. But that may not be the best way to execute for the client. And there may well be, whether it be an algorithm, whether it be a mixture of different things, but it has to be understood by the client exactly what you're doing first. So the first thing that was always most important to us was that we learn the client first. We must understand what the expectations from the client are. There are plenty of clients out there.
How do you optimize his expectations? Like how do you actually gather everything and you try to optimize to derive like the conclusions to your execution?
Well, yeah, I mean, it's you fit that afterwards. Like I said, you have to know exactly what the client wants first, because there's different
And that's
styles.
and that's the
But
relationship that you're building with the client.
exactly, exactly. I mean, that's key. So as soon as someone came on that we knew was going to be high volume over the phone, one of the first things that we do, and remember that, I mean, it could be anybody that pick up the phone to someone. There could be 6 to 8 execution dealers that might pick up the phone. So the first time that someone speaks to them and gets a flavor of how they want to execute, we then have to broadcast that to everyone else to make sure that we're consistent across a team. I mean, there are some clients, for example, who are so focused on speed that nothing else matters. Now, you
Only
have to
speed,
balance
like only
speed of
speed.
execution, right? So,
Okay.
what matters? I need to get done. I need to get done now. So, you might look at an order book and say, look, I'm going to be, if I'm very aggressive with this order, it's going to push the price a little bit, etc. But you've got to
Obviously.
balance that with
By
the
the way,
client's
what markets are
expectation.
we speaking about? What markets are we speaking about? The LST?
Equities mainly, equities. So
Equity. Okay,
our
gotcha.
our focus was always equities, and the reason behind that was if you look at assets like FX, like fixed income, etc., they're so liquid that it's very unlikely that a client's not going to be able to do what they want to do via a platform. The liquidity that was available to clients, both from internal liquidity and external, it very rarely needed us to intervene. Usually it was more of a relationship management piece or a configuration piece. Whereas with equities, it's more likely that you run into something where you just can't facilitate everybody because you need to be aggressive enough with your liquidity to make sure that that 90% of people are absolutely fine. But that's always going to leave a 10% where if you're too aggressive with liquidity, it can affect the price. And at some point there's an inflection point where it just becomes a bit daft. The outcome becomes a bit daft.
So
The,
how do you execute the order by the end of the day? Like, how do you break down the iceberg? Like, how do you actually split? Like, if we're speaking in terms of speed and the client dem- demand for speed, and how do you as hobby like build like take the entire order, take the entire capital, and literally break it down into minor parts,
yeah, so there's
like split the
obviously
book and yeah.
there are systematic ways that you can go about this. That anybody that comes from an algo background will be aware of the big ticket, the major big suite algos, your TWAPs, your VWAPs, your with volumes, etc., which are just different ways of cutting up an order for it to be sensible in the way that the client wants to execute. But so nobody, if I go right back to when I first started, there was more, almost a human acting as an algo box in that you know exactly what the client wants to do. For example, I'm just trying to get done within the next couple of hours. If you see volume that is presented on the order book, then go and take it. But I don't want you to be actively participating on the exchange. Don't put orders up. Just have a look, nick it when it's there, etc. You're acting as almost an algorithm in that, but that doesn't really happen anymore. Everything, and the reason is that there's such a wide range of algorithms available from prime brokers, from LPs, etc. Um, that you should be able to utilize something out of the package, which means that your main thing when you're setting up an execution desk or trying to look after a certain type of client, your main thing is who am I picking as my PBs or my liquidity providers, and do they have a wide enough suite that covers all of the different areas that is important to me? Do we have lots of orders going into auctions or trading in and around opening and closing auctions? Do we need dark pools for clients because of either suspicion of what goes on in exchanges or just a preference for being off the order book? Do we have enough market makers that we have relationships with that if you get really outsized orders and it's a case of just getting on the phone to a large shareholder and going a little bit more old school, do we have enough of those lines open? So it's just trying to make sure that you've got all of those bases loaded and that wherever possible, it's systematic rather than being someone having to cut up an order and do something very manual, because that tends to lead to dispute because um, there's always a different in hindsight there can always be a different. It's great to look at something with rose tinted glasses and say, oh, you should have done X, Y, and Z. And if you're doing things too manually, you're leaving yourself very open for different interpretations of what should have happened after the event. So it's always best to just try and make sure that you're doing something with benchmarked algorithms when you can, and that those are understood by the client and the risk of
What do
balancing
you refer
time. Yeah.
what do you refer to when you say the word benchmark? Benchmarks from the client. Can you please clarify that
Yeah, so
a little
if
bit
you take a
more?
benchmark, so if I say uh, uh, TWAP, for example, so TWAP takes an order and it spreads it in time weighted increments over the day. And what it's trying to do is it's a very basic order type. Um, I would guess that a lot of especially more advanced firms are probably unlikely to be using something like this now because they can be detected and are seen as being a little bit archaic. But one of the nice things about something like that is that there is, if you look at Bloomberg, if you look at Yahoo Finance or Reuters or whatever it is, nearly all of them will have a benchmark reference price for the VWAPs throughout the course of a day. So every stock will have a number at the end of the day that is the volume weighted average price. So if I work an order that's supposed to be, sorry, I said TWAP, but let's say VWAP was volume weighted, but it's the same idea. You're cutting it up by volume instead. But you've got a benchmark there. So if you go to a client with a fill at the end of the day and you say, you're filled at 100.5 for your order, and they go, oh, hang on, where's that come from? Now, if you've got benchmarks from Google, from Bloomberg that say 100.47 and 100.53, you're showing someone that you're within the band of acceptability. It's never going to be the same because you can't replicate it exactly. Everything
Sure.
does things in a slightly different way. But it's always really nice for us when we've got a benchmark, whether that be market open, market close, VWAP, TWAP, even if it's only over a small period of time, where afterwards we can prove that we have executed in line with what the client was expecting or had asked. Um, Anything that goes slightly off piece from that will always be subject, even though it might be a better outcome for the client, it will always be subject to more scrutiny. So you have to, where you go where you go off and you go into algorithms that might be a little bit more um, involved in depth, trying to do something very specific, you have to be careful to make sure that you're only using those with clients that fully understand what they are. Because if they don't, you can end up coming unstuck in certain scenarios where they either don't get a feel or whatever it might be. They need to understand how it works.
Hmm. Obviously. Let's um let's speak about, like you have mentioned, another thing. I'm just shifting gears because I really want to dive deep into the details. You have mentioned that when you actually get a prerequisite from the client, you would have to deliver it to the entire team, to the entire desk, and each part of the and each component of the desk is going to be responsible for something, or you would have to have a certain alignment in between all the parties involved. And my question is, how do you actually take the prerequisite from the client? How do you translate it into the components that you would have to deliver it, like in their language? And how do you make sure that, like, in the desk, the communication and the conversation will be properly set it up to the original client prerequisite, and you would actually maintain the communication alive with a perfect alignment to the original prerequisite.
Yeah, there's different components to that, so it's tough, and especially if it's a fast moving market or if there's stocks that are being very actively traded because there's some there's news flow on them, or you go to things like the meme stocks that everyone was going crazy about a couple of years ago. You suddenly get a flood of these more manual orders, and you need to know how to take them and what every individual client expects. And there's a couple of different elements, like I said. So you mentioned communication. It's important both within our team and what line of communication are you actually using with the client, because there's different ways to take an order. You can take it by voice, you can take it by chat, you could take an order by email. It's always been completely against my every fiber within me to take an order by email, because all I can see is that going wrong because of it's not real time. But different clients, for example, we've serviced clients in the past who, if you don't have an order, if they give an order and you don't have that order filled in the market and filled within 6 to 10 seconds, they will go absolutely crazy. Now,
Oh,
that's only doable using certain setups. So, for example, what I was saying about different ways to work an order, I can't be using an over the day order type for a client that wants to be filled in 6 to 10 seconds. It has to be on exchange, using your eyes, making sure that you're not being too aggressive, but filtering that information back to the client as well. So when you get a client that through, it's really important that they're communicating to you via the right mechanism, by the right means. So that had to be done via chat. It wouldn't
Mhm.
work with anything else. It had to be chat. And we set up the chat for clients like that, for example, to being a one to many. So they're chatting into 6 people, which means that every single time they send an order through, someone's going to pick that up straight away and say, that's mine. But it means that you're always going to have coverage because there will always be somebody available that's not on the phone. That's how you pick the order up very quickly. And then whoever it is that brings the relationship in, this is where the relationship management part is really critical. A lot of those clients tend to come to you knowing exactly what they want. They don't need you to tell them. They've done it somewhere else. You don't get to the point of having an expectation of an order being filled that quickly just because you fancy it. It's because you've developed it over a period of time. So they come in with a specific expectation, and whoever takes that call in the first place, or whoever the relationship manager is that garners that information first up, their job is to speak to the execution team, whether or not it be me running it or a senior member on there, and be absolutely clear about what the important things are. So speed is absolutely paramount in that instance. It's basically the most important thing. Um, you need to have a way of communicating that is consistent between the client and the team. You know, the way in which you give the order, whether it be, okay, I'm going to say direction first, then stock, then start, whatever it might be. You've got a consistent way of doing things. So there's no ambiguity because that means you've got to go back to the client and ask the question. I've just missed my 6 seconds. So that's a really extreme example, but it comes in so many different flavors. We would have clients who would leave very passive orders over the course of many days. Now, something like that, really, you could take that instruction over an email, but it's key there, for example, to make sure that if there's any big changes within the market, sudden bang of volume, sudden change in price, that you're communicating that in real time. And again, it comes down to the client, knowing their expectations, and making sure that if there is anything that could create any ambiguity, that you're knocking that on the head as early as possible. Um,
Mhm.
and that would be the same things throughout the whole team. So that has to be communicated throughout the whole team so that everybody knows. No one likes being blind. There's nothing worse than being blindsided by having a client come through that has a certain expectation because it's how they give orders to everybody else. And you've never spoken to them and you've got no idea what they're talking about. It's
Okay.
awful. So again, communication within the team is paramount, and we had different ways of making sure that everyone knew that. I mean, we used to communicate internally via our own chat system as well. And if there was anything that came up that was new, different, etc., it was people's jobs to summarize it, get it on there, and make sure that everybody knew where they stood. Um, any new important pieces of information were shared to everybody so they weren't left high and dry and not knowing what they were supposed to be doing. But it's a steep learning curve. I mean, when people first come in and learn the ropes for the first time, um, you've got a lot to learn about how to actually trade in the first place. It's not terribly difficult, but you do have to be able to process a finite number of things very quickly and be very sure of your decision making and what you should be doing and knowing all of the various systems that you use, what to do when something goes wrong. Now, people think that, it's like, I mean, it's not like,
How do you actually orchestrate like because it might be an orchestra of people who actually runs the events all together, and obviously there is a master who leads everyone. How do you actually construct that type of orchestra in terms of building it properly to assure that the communication that you're actually describing to me right now will be kept and saved in a very proper manner.
so when you say orchestra, you mean how do we construct the team in the first place?
Yeah, yeah, basically, because like the orchestra like compounds itself like with all the people that you're actually building the communication with.
Yeah, you need to think about balance. So the
It's
team has
balance.
to, yeah, you need to think about the making. We could have hired people, for example, in the past who would have been perfectly good at doing the job singularly, but would not have worked within a team because you have to be mindful of the characters that you have within a team and not putting the wrong people together. Um, and everyone has to buy into the process. A lot of people don't like that, you know, especially if you come from a trading background that's maybe a little bit earlier. Um, it might be a little bit more, um, I don't know, whether people say sort of shooting from the hip or the idea of being a bit more off the cuff, trading off the cuff, trading with your intuition, with your gut feeling, or whatever it might be. And because we were dealing with such a wide range of clients and they touched onto the retail side of things, you simply can't take that approach. It's too dangerous. So you have to have everyone buy into a process where you know that everybody, I could give the same order to six, seven different people, and it's likely that they're going to have maybe slightly different variations, but they're going to lead to the same outcome ish. They're going to pick the same order type. They're going to do things in the same way. They're going to say no to the same things when they're not comfortable with something. If someone leaves you an order, for example, where you say, okay, I want to buy half a day's volume in a stock, and yeah, you guys just do it how you please. Just be sensible. I don't care if it takes a week. Is that okay to leave the order with you? No, because that leaves you very open to a number of different things happening in the interim where you don't have clarity as to how you're supposed to be working that order. And if you can't speak to that client in the interim, if a set of results comes out the next day, it might completely change the landscape of both the liquidity, the price, everything. So you have to know when to say no as well. And um, it was really important to know that when we were bringing people in, that they had a personality that suited the rest of the desk, and that they would buy in to that to that that procedure, that framework, etc. Being more systematic about how they trade, and that often meant that we tended to hire people with less trading experience and maybe more experience internally at the firm, so that they knew the systems, they knew the people, etc. And then when they learn relearning something quite hard, you take anybody that's traded in the past, whether it be for their own book or for a client, and you try and put a different trading system in their hands, they will absolutely hate it from day one. And it doesn't matter whether or not it's a better system or not. Everybody is fallible with the same thing. You've got things presented in a different way. Buttons are in a different place. People will instantly say, well, in my experience anyway, if you take someone, you put a new system in front of them, it could be the best one out of that. Until one look at it and say, that's rubbish. Don't like it. Because it's new,
Mm-hmm.
it's different, and people don't like that. So becoming a creature of habit is a very, very good thing. And for us, it tended to be a lot easier to take people that were really hungry, maybe a bit younger, maybe didn't had limited trading experience, perhaps. That's something that we could teach, but we could teach it in a structure that fit within the rest of the desk. And it makes the desk work with a lot less. It's a lot less bumpy. You get everyone buying into the same way of doing things, and the error rate on that particular desk, considering the range of clients that they spoke to and the range, and how manual the execution was very early on, was incredibly low. And I think that was by part because the way that the desk was set up from the outset, with trying to keep everybody's being mindful of characters and how they bought into the process of how everything was we went about executing stuff.
Mm-hmm. I got it. Um, Look, it's a very interesting but very logical approach to set up a team of individuals that have like alignment to the characteristic to the other characteristics in the table. Um, and I would like to ask you another interesting questions about execution and about clients is about how do you acquire new clients? How do you assure that the client profile actually aligns to the facilities that you know you have and things that you know that you that you're actually capable of delivering and how everything is actually come together into the flow that we're speaking about like the entire conversation and like acquiring client, making sure that the execution is it will be spread out across all the team members, and then making sure that the order will fill properly to the needs of the client.
Yeah, you don't always have the choice. So, clients will tend to come through you through some sort of sales channel, and you'll never meet a salesman who wants to put down a sale because they can't think they don't think either the desk or the company is capable of executing a certain type of business. That's not natural to any salesman to say no. So
Although,
the communication was always key between sales and my desk or the relationship management desk who would end up taking the client. But you don't often get, sometimes you don't get all the information that you'll need, and you have to think a little bit more on your feet, which is why it's very important to constantly be asking that question. Some of the things that you touched on there, can we do everything that the client wants to do? Are there going to be any problems from this? Do they fully understand? Is there going to be circumstances where times of the day, etc., that what they're doing is going to be either impossible or could cause a lot of issues? Um, I mean, I go back to when I was in my first role, and I'd probably been trading for about a year and a half or something like that. There was a new client that came through that everyone was talking about in the sales department, who had promised the world. And you hear of this a lot where everyone comes through and they're, oh, we've got an enormous client coming through, a huge client. It's going to be massive. And okay, fine. And then it comes through the door and it ends up being a tenth of whatever was described. Now, I don't know what was promised for this early straight away, but it was around the initial deposit and what they were looking to do with it. And my understanding was that the client was going to put in a couple of million, for example. And someone suddenly came over to the desk and say, the money's in. And on the next Monday, 20 million turns up in the account, which was not expected at all. Now, we also didn't really know exactly how this client was going to want to trade. A lot of things we subsequently found out quite a lot about quirks in how the client liked to trade that had a deeper explanation to them. But cut a long story short, I mean, I didn't really have that much opportunity to speak to anyone that had spoken to the client before, and find out more about the style that he liked to trade, etc. And then I took my first call when he came through. It was about half an hour before the market opened in the US, and we traded $250 million worth of Apple with one phone call, which was an
that's
astonishingly
that's
large
insane.
order for an individual to be doing around that time. And then you have to think about mechanically as well. You get problems that come from off of that with things like limits. Each firm that's executing on behalf of the client will have limits with prime brokers or whatever it might be. You've got to be watching that and thinking, are we going to hit a limit? Whether that is the limit for the day, a limit for the order, a limit for the order type or the stock or whatever it might be, because there's lots of different flavors. So you have to be really careful that you don't end up putting yourself in a bit of a corner, trapping yourself in a corner with being not able to exit something that you've entered or something like that, because that's how it can cause huge dispute and huge monetary, penalty, if you like, in those sorts of circumstances. So you don't always have the luxury of being able to plan in advance. Sometimes you need to think on your feet. And like I say, one of the big things is also knowing when you can't facilitate what someone wants to do. You have to be brave enough to stand up. You know, if you have limits with a prime broker, for example, of being 500 million for a day,
Hmm.
and you've already eaten up most of that, and you have an in and out limit, you know your net and gross limits for the day are the same number. So if you haven't tinkered with it, sometimes what you can trade in a day, both in, so new exposure, and in and out, are the same value. They can be, or they sometimes it's not set up to be many multiples. And what that can mean is if you trade into $500 million worth of exposure, and then you try and trade out of it, you're going to have hit that limit for the day, even if it's reducing trade. So you need to
Hmm.
really think about these things in advance and make sure that you're not going to have a really catastrophic stumbling block along the way. But that is about structure within a firm and making sure there's really good lines of communication between the trading desk, the desk that maybe manage residual exposure that would come through online and look after any book that's being run, and then your operations teams, your settlement teams, your liquidity risk and market risk, etc. You've got to have really good seamless lines of communication with them so that when something like this materializes, because you can't prepare for everything, you have to get them involved straight away so that everybody makes a considered decision about what needs to happen next. But fortunately, that very rarely needs to be, we need to hold fire. Most of
Hmm.
the time it is, we're going to find a way to do this behind the scenes and
Hmm.
learn a bit more about the client as we go.
Toby, I know you're the type of of the guest that I really like because I feel like you know there's no need to direct them onto different types or onto different subjects because you're actually putting everything on self-explanatory and I really appreciate it. And I think that the way that you put that you put like your experience into words is very well appreciated. Um,
No worries.
um, and and um, and just a quick question before we go, just out of curiosity. I saw over your LinkedIn that you have a physics background. How
Yeah.
do you why
Yeah.
do you laugh?
Yeah, I mean, I have a physics background. I wouldn't say I've used it much since I've been at work, but yes, I do. I do have a physics degree. Yes.
Do you think that it's still applicable to have like STEM background to enter the industry in various types of
Um,
industry?
yes, I do. I think that you probably find this unless you go into a what I would call a career, a career subject, medicine, law, things like that. There, it's really prescribed what you're going to end up doing. If you take STEM subjects or core subjects, whether it be a maths or I'm going to take numerate ones because I'm biased to that because what we do, you, it's not hard maths, it's not Schrodinger's, it's not Black Scholes in your head or anything like that. But it is quick, fast decision making that needs someone to be numerate and confident. And um, I think the problem solving element of it is very natural to people that come from either a physics or an engineering background as well. That kind of problem solving element. And one of the things about trading, like I said, nothing that you come across is going to be ridiculously complex. Um, but you do have to make decisions very quickly. And a lot of the trading platforms, for example, not for us because I wouldn't put us in that bracket of active trading, if you like, prop trading, active trading, whatever you want to say, maybe a bit more trading off the cuff or going out and seeking exposure. We're executing on behalf of clients and trying to find the best way to execute within what the framework that they've given, etc. But we're not waking up one day and saying, "Oh, I think I should buy gold" or whatever it is. So we'll put that to one side. But a lot of the really high touch trading, especially if you go back a few years to when I first started. I know that a lot of them were using psychometric testing that is used primarily on things like pilots, for example. Pilots making quick decisions. Everyone's been in a cockpit and seen how many buttons there are, right?
Obviously.
Now, hopefully, you would, you, under most circumstances in most flights that we go on, most of it is handled by a computer. But it's knowing that when those pilots have to intervene, that they know exactly what they're doing and have clarity of thought about what the best thing to do, problem solving really, really quickly. And I'm not trying to say that anybody that trades could be a pilot at all, but I'm saying that there are crossover skills in there. And that if you come from an engineering or physics background, I think it lends itself a lot more to that. It doesn't necessarily mean that you can do it. I often find that people that are very intelligent, really intelligent, struggle a little bit more with it because they want to process more. They want to think more before making a decision. And actually, if you look at trading overall, um, the other element to what we do is obviously seeing a lot of people trying to make money, seeing a lot of people, what type of system do they use, how have they come about it, and quite often you see that some of the best, we don't really see like high frequency stuff because it would be too expensive. If you want to be a high frequency trader, or if you want to make money out of high frequency trading, you're going to need to be at one of those outlets that has the infrastructure to do so, and they're fairly limited nowadays because you've got to be so quick and have so much processing power. So where we see people try and make money is on the more medium-y term, I would say, not necessarily long term because you do that as an investment, but medium term, short term decisions. And quite often you see the people that are most successful, they have very simplistic ideas and they're not trying to overcomplicate things because
So
sometimes
you're
you can.
actually speaking about like the ability to correspond to current situations that are actually occurring, instead of like having but how do you actually leverage the mathematical background and the, I don't know, the clarity from having like a STEM background to have like a much more um, um, concrete path to correspond to new situations?
Oh,
In
I
your
mean,
mind, or out
I'm
of
not
your
really sure.
experience.
I'm not really sure whether or not the STEM background side would affect whether someone's ability to pick a trade, for example. It makes you more, pattern picking a pattern,
Python
solving
driven.
a problem, logical. But
Yeah.
but you really, in my experience, the people that have done best are tend to stick to things that are fairly simplistic. They keep with a fairly simple idea. Sometimes that can be repetitive. It might be trading around the open because they've spotted some sort of pattern or a reversion or whatever it might be. But you have to stick to your system. And I've seen some people do some crazy stuff to try and stick to a system. It's the hardest thing in trading is to try and stick to your system and not be tempted to change something just because of circumstance. Um, because what it does is it throws your data out the window. You can't optimize something if you keep changing it and you don't know how you're changing it. So yeah, like I said, I mean, I've seen some crazy approaches to this where I had one client who used to trade around. It was actually around when the European debt crisis was in full swing. And he used to do a lot of trading around the secondary move around some of the downgrades because he felt that there would be a shock reaction, then it would retrace a little bit, and then there'd be another huge move once the market kind of digested it. So he was always on trying to see, where's the next piece of Greece news or Italy or Spain or whatever it might be on the sovereign debt downgrades. But he really struggled with sticking to something once. I think it was like let's call it a 10-to-1 ratio. So um, profit to loss, best. It's always great to have a structure in play beforehand. and he would have a 10 to 1. So his, let's say that his stop was 100 points away, he would have a limit that was 500 or 1,000 away. He's trying to take a big move because that's ultimately what he's looking for. um, and he wants to make sure that he only has to get a few of them right to be profitable under those circumstances. But he really struggled to stick with his with the system that he kind of wanted to stick to. He was really struggling that when he entered a trade, um, he would watch the market, watch the charts, everyone does it, and then make a snap decision based on what was going on. You know, all of a sudden the market retraces, which is something that he expects. He starts to get a little bit panicky and say, no, I'm going to get out. Or all of a sudden there's a little bit of profit, you know, maybe 100 points worth of profit where you're looking for 500. Um, and the temptation to take that as soon as you see something in the green is almost unbearable. But that throws his system out of the kilt because all of a sudden he now needs a 50-50, 50-50 strike rate to make money, or slightly better, 51. So his plan for this ultimately was a bit Stone Age like. He would set up a trade, and when he
Right.
got into a trade, he would put his stop on, he would put his limit on, and he'd pull the plug out of his PC
Huh.
because it was a barrier to get. He knew that firing up my PC is going to take me 10, 15 minutes. And by that time, there will have been a natural outcome to my trade anyway. And it was one of the only ways that he could keep that, you know, just just be just be really consistent, resilient, and stick to the plan. And people come up with some wacky ways of trying to just manage their own, manage it's managing your emotions really as much as anything. Um, and yeah, people come up with some very strange ways of doing that. But it's one of the biggest things to do is to try and keep things very simple. In my experience, anyway, from people that I've seen that have made money over a
Totally agree
consistent
with you.
period of time.
Totally agree with you. All right. You know, as I told you, I think that you're a very interesting individual with a very interesting background. And I'm really glad for the opportunity that you came here and you shared with us your background and your story and your insights from different parts of the industry. And I really appreciate the opportunity to do so. So
Cool.
I
Well,
really
thank
appreciate it,
thank
Tom.
you as well.
Thank you. See you next
Cheers.
time. Cheers, mate.